In this video, I'm going to talk about how you can lower your property taxes in the UK. Now, first off, I want to kind of give a little disclaimer here. I'm not an accountant. I'm not giving any tax advice here. I'm just giving some general kind of information. It's really important that you go and get some tax advice from a decent tax planner, because everybody's situation is very different and unique, and you're going to need some tailored advice according to your own specific situation. So let's just go back to how things used to be done. Most of the time, people used to buy properties in their own name, and many people did that for many years. You'd buy a property, you'd have it in your own name. You would then have that income classed as income tax. Okay, that would be how people used to do things. You'd go down on yourself, sir, or you'd get your accountant to sort that out for you. Now, that all changed in 2017 when the government introduced Section 24 tax changes, which in essence meant that there was no more mortgage relief. So if you had a property that you was renting out, let's say the rent was £1,000 a month, your mortgage was £600 a month, you would then be able to offset that mortgage and only pay tax on the £400 profit. Well, that mortgage relief was scrapped. It meant that all of a sudden, instead of having to pay tax on the £400, you was paying tax on the £1,000, which meant that in a very quick space of time, property portfolios were no longer profitable. So what a lot of landlords did was, some landlords decided to quit, retire, sell off their portfolio. Some decided to move their portfolio into a limited company structure, which I'm going to talk about in a minute. Others decided to sell their properties and then buy a new portfolio in a limited company. So really, this is the key thing, okay? A limited company structure is really the way forward. So, since 2017, we've had many like mortgage lenders come into the market. They're very happy to lend on company structures. There's some very favorable rates, as long as the deal is a good deal, as long as the deal stacks up and it's a profitable deal and it's something they're happy to lend against, okay? So we've now got plenty of mortgages available. The main advantage of using a limited company is that you can offset lots of legitimate business expenses. So when I used to run things through my own name, there was only so much that you could put through as an expense. But with a limited company, you've actually got a lot more things you could put through as legitimate business expenses, not just property-related stuff. Sometimes it was travel. Sometimes it would be office space. Sometimes it would be things like having a coach or a mentor or consultancy. That could all be put through as a business expense, where sometimes the accountant didn't really like it when it was all going through my personal name. So these are the other kind of expenses that you can put through, which means that if you can kind of put more expenses through your business, legitimate expenses, it means that your profits are a lot lower. In general, limited company taxes are way lower than income tax, okay? If you decide you want to sell a property that's in your own name, you're going to be subject to capital gains tax. Now, as an individual, there's about £12,300 tax free, and then anything over that, you're going to pay between 20 to 28%, depending on your personal tax situation. Now, again, everyone's tax situation is very, very different. The exception to that is you don't normally pay capital gains tax on your own home and your own main residence. So one of the things that sometimes people do is they'll move into a property, they'll treat it as their own main residence, they'll fix it up, do it up, live in it as a fixer-upper, and once it's done, they'll sell it and they'll keep moving up the ladder, so to speak. That's one way of doing things. But if you're not doing that and you've already got your main residence and you are doing investment properties, then really the best way to go is a limited company, okay? The reason for this is because if you sell a property and you sell that property through a limited company, you're subject to corporation tax, which at the moment is 19%. It might change at some point, but that's really a much more cost-effective way of doing things. Now, most landlords, if they're going to buy stuff, they're going to buy stuff and hold it, which means that, over a period of time, you're going to get capital growth and you're going to get a rise in equity. So people are sometimes worried, well, should I kind of sell that property and take the money out of it? Well, that's not a smart move. What you're better off doing is remortgaging the property and taking equity out. Now, the thing is, if you remortgage a property, it's tax-free because it's classed as debt. So what a lot of people do, and I've done this myself, is you remortgage a property, take the money out, it's classed as debt on your balance sheet. You then use that money to buy another property or use that money to develop one of your existing properties. I'm doing it right now. I've remortgaged one property. I'm taking the money out of that to build 2 flats on the back of another commercial property, which means that it's low money, it's cheap money for building 2 additional units that will give me some really good additional cash flow to my portfolio. So this is the kind of stuff that you want to do, okay? You want to, in an ideal scenario, hold the property long term, remortgage it and keep taking the money out. As it goes up in value, keep taking the money out. Of course, you've got to make sure the rental income will cover the additional money that you're borrowing, but normally over time, as the value goes up, rents go up as well in alignment, okay? The other thing you need to be thinking about when it comes to saving tax is inheritance tax. So if you have got children, in fact, there's a lot of people who come into the academy that want me to help them to grow a portfolio. A lot of the time they want to leave a legacy behind. They've got children, they've got family members, or they've got charitable causes where they want to leave a portfolio behind. You need to start thinking about I guess the right word is tax planning to avoid inheritance tax, how you can pass things on. Now, again, I'm going to share something with you, but you're going to have to go and get some specific tax advice that's bespoke and specialist to you, okay? You can gift assets to family members. You can gift assets away, but there's a certain way you got to do it. And I think you've got to be alive for about 7 years or so beforehand, and you can legitimately give that away. But again, go and get some advice around this and make sure it's right for your specific circumstances. So you want to be thinking about the end goal in mind. What are you going to do with your portfolio? Are you going to just hold it? Are you going to just kind of keep it and take the rental income from it? Do you want to pass it on at the end of the day? And ultimately, sometimes it's better to start with the end in mind. Go and get some good tax advice. Go speak to a good tax planner who can help you set this stuff up and set the right structures up to make sure you're doing things the right way. So I hope you found this video useful. Please like and subscribe. If you've got any comments and questions, put them in the comment section below. And I look forward to seeing you on the next video. Take care. Bye for now.